Global markets closed the month on a high note as tech stocks continued their rebound. A recovery in chip stocks propelled indices higher, capping off a turbulent period for AI-related equities that had seen significant valuation corrections earlier in the year. Meanwhile, currency traders kept a close watch on the Japanese yen, monitoring the risk of further government intervention after Japanese authorities were expected to step in to support the currency. One of the standout stories of the day, South Korea's Kospi index surged an extraordinary 18%, a remarkable single-session move driven largely by the semiconductor rebound. But what drove the AI sector's sharp decline in the first place? According to analysts, the sell-off was not primarily a collapse in confidence. It was a deleveraging event. Some institutions were not selling because they turned bearish on AI. They were selling because their leverage was too high, forcing them to liquidate positions. Many retail investors mistook forced selling for a fundamental breakdown in corporate value. Enter Cided. The firm acquired a significant block of shares from situational awareness, effectively removing one of the market's biggest overhangs. While Cided is no charity, the acquisition was made at a discount with full expectation of a return. The move had a stabilizing effect. It transferred the most dangerous source of potential liquidation orders away from the open market, giving short sellers reason to cover and allowing the market to breathe. On the macro side, the Federal Reserve continues to face a difficult balancing act, fighting inflation without choking growth. Fed Governor Warsh struck a hawkish tone this week, yet rates were left unchanged and forward guidance was pulled. That ambiguity has rattled the bond market. The 30-year U.S. Treasury yield is now hovering near its highest level in nearly 19 years, above 5.2%, a level that structurally compresses valuations for high-growth tech stocks. In this environment, markets are increasingly focused on one question: which AI companies can actually turn capital expenditure into real profits? Amazon's latest earnings report offered a compelling answer. The company posted revenue of approximately $200 billion this quarter, a 20% year-over-year increase. Net profit came in at $27.5 billion, up 43% year-over-year, well ahead of expectations. Amazon also raised its full-year capital expenditure plan from $200 billion to $220 billion, a 10% increase. What separated Amazon from Google, whose stock fell after its own earnings release? Communication. Amazon's CEO explained precisely how those capital investments would translate into future revenue streams. Investors don't fear companies that spend money. They fear companies that can't explain why. The bottom line? The AI sector will continue to grow, but not every company will survive. The market is in the process of separating those with genuine technology, real customers, and sustainable cash flow from those that are simply telling a story.